So when you start in the Forex market, there are essential things that you need to understand that revolve around risk. You know, how much you're trading, the deal size that you're trading, and how much margin you're putting into that trade, where you're going to place a stop loss. So the first thing you need to do is just understand these elements of trading. Now, the next thing, and it's actually a common mistake, is that traders consider, when they're trading, they only consider market direction. You know, how is it going to move up and down, and how far is it going to move up and down? But there's a really important thing that gets forgotten here, and that's volatility. Because a trade may move from one point to another point over the next day. But in between those points, it could go hugely up, it could go hugely down. So volatility is a really important element to consider. Volatility literally measures the fluctuation in price over a certain period of time. So let's take gold as an example. It's a very volatile product. At the moment, it's trading around $1,100. Now, if over the next day, gold volatility was 1%, it would mean that it would either move $11 up or $11 down. There's going to be $11 in fluctuation, potentially. But if the volatility was 5%, you're looking at $55 up or down. So the difference between this move is a lot. So if you're trading and you want to buy gold, for example, if you haven't considered the volatility, how do you have any idea where to place your stop loss order? Do you place it $10 below? Do you place it 30 or 50? And if a market is more volatile and you know that the market is expected to be more volatile, then you may consider to use a wider stop loss order or decrease your trade size to account for being able to use that wider stop loss order. And it's something that's forgotten all the time. People often just go into a market, buy or sell just on direction, but they're not considering what's going to happen in between this point and the point that you want the price to go to. Is it going to fluctuate up or down? So commonly, stop losses are hit. And it's not a very nice experience for a trader to have their stop loss hit. And once you've experienced that, you have a tendency, when you see your trade losing, to move your stop loss further and further away. And what are you doing? You're just increasing the risk on that trade, and you get stuck into that trade with a big loss. Yet if you have an idea of the volatility from the outset, before you've put the trade on, you will have a much better plan for where to place your stop loss order. So if you're trading any asset class, you need to understand the drivers, what moves that asset. It doesn't matter what you're trading. If you're trading stock, currency, gold, oil, you need to know what are the drivers of that price. So that's what you've got to do in the first instance. You've got to study and find out what's driving the price and monitor historically what's happened, monitor over some time what is happening in the markets. And when you've got to grips with that, you'll have a good understanding of the consensus of the market and where that's going. It's also good to know that there are lots of different ways to trade. You don't just have to stick with one idea. You know, you don't just have to day trade where you're in and out of the market within a day. You can take on longer term positions. There are lots of different instruments that you can use. You can use these short term instruments, which is spot trading, or you can use longer term, which is forward or futures trading, or you can use option instruments. So you don't have to stick with the same instrument every time you're trading. And I think that there's a tendency for traders to always go towards the most popular instrument, which is short-term spot trading. But that's not necessarily always the best instrument to trade. So you need to understand the environment that you're trading in and the best instrument to use. And by using different instruments, you're changing your risk diversity as well. And it's very good to make your risk diverse. So you're not putting all your money into one place, you're spreading it around a bit, which creates a more balanced portfolio. I would say always understand the environment that you're trading in, because the environment of the market can change. It can be trending, it can be more or less volatile, it can be in a range. So always understand and take a look of the current market environment. And then have an awareness of not just trading in one instrument the whole time, choosing from a choice of different instruments and diversifying your risk.